Hello there. Um, this is a video where we are going to discuss long-term performance management. The slides that you are going to see in this video have already been uploaded onto your portal. If you wish, you can pause this video and open up the file which is called 3304-3. This topic is about investment in non-current assets. This is why it's called long-term performance. When you invest in long-term assets or non-current assets as they are called in accounting, the analysis is called investment appraisal. For businesses, this is also sometimes called feasibility analysis. Business feasibility is, of course, not only financial feasibility. Feasibility can be strategic feasibility, operational feasibility, environmental feasibility, management feasibility, and of course financial feasibility. But for our discussion here, we are going to focus on financial feasibility. So what does financial feasibility mean? It means that this new investment that we are going to undertake in non-current assets will add to the shareholder value of the company. Now, if you are going to look at whether the shareholders, the people who own the business, get sufficient returns or not, you would have to ask yourself the question, how much should be the required rate of return from an investment in new fixed assets or non-current assets? If you are looking at the historical performance of a company, you would probably use your ROI or ROA, which is the return on investment in business assets. But if you are talking about investment in the future, then you want to know what should be the required ROI. And hence the situation is a bit different from what we saw in the first part of our analysis when we were using ratios, financial ratios. So here we need to ask ourselves, if we are going to commit the long-term money of the company to an investment in fixed assets, how much should be the required rate of return? The investment could be in fixed assets such as plant and machinery. It could be a renovation of our factory. It could be a renovation of our showroom. It could be us purchasing a fleet of vehicles. If you are in shipping, it could be purchase of vessels. If you're an airline, it could be purchase of aircraft and stuff like that. We need to find out, for every dollar that we are going to commit to the new assets that we're going to buy, how much should be the required return? Well, in finance, the answer is you have to compute the cost of capital. Cost of capital is a required rate of return. This cost of capital, the required rate of return, is calculated by listed companies. Listed companies have a methodology of using market rates of return to find out what should be the required rate of return for new investment. So what does all this mean? It means that listed companies look at the kind of returns which people who buy their shares or buy their bonds are getting currently. And those are market rate of returns. So it is in essence a listed company going out to the market and asking the market for an opinion. What kind of returns would you like if you bought shares in our company? What kind of returns would you like if you lent money to our company through our bond issues? From here, it should be clear to you that when you buy shares in a company, you become a shareholder. That means you're the owner of the business. And if you buy bonds, then you're a creditor of the business. You're lending money to the business. The approach that we use here is that we look at the returns that are provided to equity shareholders and the returns that are provided to bondholders, and we work out a simple weighted average of the returns. Simple average won't do. If we do our market survey and we find out that the required returns on our shares by equity shareholders are currently 15%, and bondholders want 5%, so 15 plus 5 is 20, divided by 2 is 10% average returns. That would not be good enough. It's too simplistic. So we work out the weighted average of their returns instead. And what does weighted average return mean? We ask ourselves, what is the total market value of equity and what is the total market value of the bonds? And we use the market value of equity and bonds as the weights for getting the weighted average. So if the market value of equity is 70% of the total market value of the company and bonds represent 30% of its market value, the weighting will be 0.7 to equity and 0.3 to the bonds for whatever returns that we want. Let us take an example so that this will become clearer. Let us say if the total market value of shares in a company is 300 million and the bonds issued have a market value of 200 million, then the total market value of the financing or of the capital, long-term capital, is 500 million. That is the 300 million plus the 200 million. The proportion of equity in this case is 0.6, which is 300 million divided by 500 million. And the proportion of debt financing is 0.4, which is 200 million divided by 500 million. Whatever value we get for the required returns from equity will be multiplied by 0.6, which is the weight, in our weighted average calculation. In the same way, whatever value we get for debt financing will be multiplied by 0.4 when we do the calculation for weighted average cost of capital, which is simply the required return on new investment that the company might undertake in fixed assets. Quick check on terminology again. Equity shares represent the money invested by shareholders, and they are the owners of the company. They are the risk takers. Bonds are issued like shares by a company, but basically when the company issues bonds, they are borrowing money from the public. So bondholders are therefore creditors, not owners. Also, please note that when we do our calculations for cost of capital, we work with market value of equity and debt. That is to say, you cannot use the value of shareholder equity from your annual report. That is called book value or balance sheet value. We need market value of equity. So by default, this means that the methodology that we are using applies to listed companies only. Only listed companies have a daily quotation of their share price and their bonds. So therefore, only listed companies will use this calculation to compute cost of capital, which is required rate of return. So then, you may ask, what do non-listed companies do? Well, non-listed companies will identify similar listed companies and compute the cost of capital for them and use that as a benchmark for establishing their own required returns. So if we are a private company in agricultural business, we could look at listed companies in agricultural business or plantation, compute a required return for them, and use that as a basis for our own required return. We could either use that return directly, or we could make some adjustment for differences in risk, location, and stuff like that. So this calculation that you're going to do assumes that you are part of a large listed company. You are going to go into the market. The market has equity shares in issue, and the company has also issued some bonds. You are going to ask market experts, what is the required return on our shares? What is the required return on bonds? These market experts will give you a certain value for the required return on your shares as well as your bonds. You will then take the market value of your shares and your bonds to get a weighted average of the two values. The weighted average will then become your required return. Let's see. Back to our example. If our company has a proportion of equity to debt 60-40 or 0.6 to 0.4, we say that let's now go and find out what is the required return on equity. Let us say an investment bank has done the market survey for us and has found that the required return on our shares is 15% per annum. And they have also calculated the required returns on bonds to be 5% net of any tax benefit that we might get because we pay interest on bonds. You will know that when you pay interest on bonds, you are entitled to a tax rebate for the interest that you have paid, because interest on borrowing is a tax deductible expense. So when the investment banker or the investment advisors so with a cost of equity capital at 15% and a cost of debt financing at 5%, what would be the weighted average cost of capital? Answer: 0.6 multiplied by 15% plus 0.4 times 5%. That's how you do a weighted average. And in this case, we would get the answer to be about 11%. Our company can then use this 11% as a required rate of return for all new investments. Essentially, what we are saying here is that every new dollar that is invested must provide a return of 11% in today's terms. And now that's the special catch here. In today's terms means that we want to make sure that all the future cash flows that we get from the investment are adjusted to their value today at the rate of 11%. That is called present value. Now, in this case, the 11% cost of capital that we have will be used in a methodology called discounted cash flow, DCF methodology. You can actually check on DCF methodology from several YouTube links. Not all of them might be the best explanation of DCF, but I will let you have some adventure with this and see what you understand by DCF. And if you have any questions after your adventures on YouTube, you can always post any questions on the forum, which I'd be happy to answer. So basically, discounted cash flow is a method where we state the value of future cash flows according to their value today at a given required rate of return. So if our required rate of return is 11%, and I say that it cost me an opportunity cost of 11% to put $1 to buy this machine, it costs me 11% required return to buy a fleet of new motor vehicles or to upgrade my computer system or security system, then 11% becomes my benchmark required rate of return. DCF allows me to test whether I am actually achieving this 11% return or not. So some terminology. Firstly, discounted cash flow. As I said, discounted cash flow will give you the value today of future cash flows. And why do we need that? Because our investment is today. Our outflow of money is today. However, our earning is over a period of time. So to bring it to equal footing, we restate the future cash flows according to their value today. That is called present value. Now, why do we need to take future cash flows and restate them according to the value today? That is because money has a time value. Money has a time value is a concept which means that money loses value over time. If I was to ask you, I would like to give you $5,000 today. Would you like it today or would you like it in 2 years' time? I think the answer is obvious. All of us would say we want it today. Why? Because we recognize that money received today has greater value than money received in 2 years' time. And money received in 2 years' time would have greater value than money received in, say, 5 years' time. Because when you get money today and now, you could invest it. You could earn interest on it. It could help you solve your liquidity issues. And of course, if the cash flow is going to be received in the future, there's also the element of risk. You may not see the money at all. Or if you are receiving the money in a certain currency, the currency value might fluctuate. For all these reasons, there is time value of money. And so this methodology is beautiful methodology which actually takes into account the fact that if you invest a certain amount of money today, the future cash flows from this investment should be compared according to the value today of all those future cash flows. And the idea is you can YouTube this too. Make it your best friend. Let's continue our story. We have established that the required rate of returns for our company for long-term investments is going to be 11%. So next we can ask the management accountants in the company to prepare a projected cash flow schedule. This is done by business development or financial controllers or management accountants or financial planners. Indeed, some of you who are in a management position may be required to actually present cash flow projections as part of your work. Now, when you present these cash flow projections, you may need to analyze them. You may need to test them. And I'm going to show you some of the testing that you can do from a financial perspective so that you can test the financial feasibility of these projected cash flows. So let us say, in our example, we have told our management accountants that whatever new investment we undertake, we will want a return of 11%. And we invite them to give us a projected cash flow schedule. Let us say they have come up with this. They say to us that the investment that is required in the new assets is 530099. Year zero means now, upfront, or at the start of an investment period. And then they have put down the cash flows that will occur during the first year, the second year, the third year, and the fourth year. Usually this would mean that the asset that we are talking about has a useful economic life of 4 years, but this need not necessarily be the case. Many companies often have a cutoff point to say that if an asset can make us money within the first 4 years of use, then it is safe enough to invest in this asset. So this could be actually a 10-year asset, but which we are evaluating for only the first 4 years. When you do this, the methodology, by the way, is also called exit net present value. That means, although the asset can be used for 10 years, I will see what is the net present value that I earn or what is the profit that I earn at my rate of return if I exit after 4 years. But in this case, let us say this asset has a useful life of 4 years. And by the use of this asset, which cost us $530,099, we will get incremental cash flow from selling more, 220,000 in the first year, 280 in the second, 350 in the third, and 400,000 in the fourth year. That's the good news. But of course, there are going to be increased costs associated with the use of this new equipment. And our cash flow of expenses will increase in the first year by 50,000, in the second year by 60,000, in the third year it is going to increase by 75,000, and in the fourth year we will be spending 90,000 more because we have this new asset. So if I take the inflows minus the outflows, I should get my net cash flows. And my position of net cash flows before tax will be that I will now have to invest 530,099. In the first year, I will have a cash surplus. Please note that this is now a surplus, a profit of 170,000. In the second year, I will have a cash surplus of 220,000. In the third year, I will have a cash surplus of 275,000, and in the final year, I will have a cash surplus of 310,000. Let us say that after computing rebates, tax allowances, and stuff like that, we are taxed 20,000 for the first year in relation to this additional 170,000. And for the second year, because we have 220,000 extra cash flow, our tax bill goes up by 30,000. And in the third year, the extra 275,000 cash income attracts a tax of 35,000, and in the final year, we have to pay over to Inland Revenue 50,000 additional or incremental tax. And this means that our after-tax final net cash flows would be that now we have to invest 530,099. In the first year, we will get 150,000 surplus after meeting all expenses and after paying tax. In the second year, it will be 190,000 surplus. In the third year, 240,000, and in the fourth year, it will be 260,000. A thing to remember here is that I have not put down a cost of loan repayment or anything like that. That is because loan repayment is a financing cost, and I am already taking financing cost into account when I apply the 11% required rate of return. So if I included interest or loan repayment, I would be charging that cost twice. That is another benefit of the discounted cash flow methodology. It allows you to compute the required rate of return and at the same time take into account the cost of using long-term money, because that is what required rate of return is all about. It is the cost of using long-term money, weighted average cost of capital. So if we apply weighted average cost of capital to the numbers that we have got, we will get what we call the present value schedule. We can compute present values by multiplying each one of the cash flows with the relevant discount factors. So if you look at these cash flows, I will discount 530,099 by the discounting factor at 11%. For our mutual reference, it may be good to remember that the discount factor at year 0 for whatever rate of return you are discounting is always 1. 1 means that the value of $1 today is $1. There is no depreciation in the value. There's no time value of money adjustment. $1 today is $1. 530,099 today outflow is worth 530,099 in today's terms. So basically what I'm saying is that upfront cash flows need not be adjusted. So adjustment starts from year 1 onwards. We will restate 150,000 according to its value today, assuming that cost of money to us is 11%. We will take the cash flow from year 2, 190,000, and restate it according to its value today at 11%. And again, we'll do the same for the 240 and 260,000. And this is what we get. The present value for the 530,000 cash outflow is, as we expected, 530,099. The year 1 cash flow, 150,000 multiplied by 0.901 will give me 135,135. And I hear you saying, but wait a minute, where did you get the 0.901 from? Well, that's easy enough. Again, you go back to Auntie Google and you can look up what we call discount factor tables. If you look at a discount factor table, it has columns with different interest rates. You have to look up the column for 11% and follow the row for year 1, and you will actually find this as 0.901. It's as easy as that. So all the maths is already done for us. For year 2, if I need to adjust the cash surplus of 190,000 at 11%, the factor that I will get is 0.812. And the present value, the value today is 154,208. This means getting 190,000 at the end of the second year is the same as getting 154,208 today. And we do the same thing for year 3, 240,000 times 0.731, 260 times 0.659, and we will now get present values. This is the value today of all the cash flows that we are going to get from this investment, including the investment that we are making today. When we add up all the present values, the answer is called net present value. So what's net present value? Net present value is simply the sum of all the present values from a specific investment. In this case, if I added up 530,099 plus 135,135 plus 154,208 plus 175,486 plus 171,280, I will get plus 106,000. So that is actually a surplus of 106,000 in present value terms. What does this all mean? It means that after providing a return of 11%, because we have discounted at 11%, we have already charged the cash flows with a cost of 11%. So after providing a return of 11%, there is still a surplus cash profit of 106,000 from this project. So if I asked you, does this project give the 11% return that we want? The answer should be yes, of course it does. It gives you 11% return and then some. It gives you 11% return and a bit more than that. It actually gives you a surplus of 106,000 from the investment. Now, let us just remind ourselves, 11% required rate of return is based on the required return by the shareholders and the bondholders together. The shareholders will get the return that they want if we can achieve a return of 11%. But if net present value is positive, if it is surplus, it means we are able to provide shareholders with a return over and above what they require. This is why you will find that often textbooks of finance and articles on finance will tell you that net present value is an addition to shareholder value. How is it an addition to shareholder value? It is an addition because we are now able to provide returns over and above what is required by the shareholders. If the shareholders wanted 11% and this project provided returns of exactly 11%, net present value would have been 0. And if net present value would have been 0, we would have said, well, that's okay. We wanted 11%, we get 11%. But right now, we have a situation where we say we wanted 11%, but we get the 11% and an extra 106,000. So please note, net present value is a surplus cash profit after the returns have been provided for. So the new business standard nowadays is actually not just about whether you are making profit, it is about whether you are making enough profits, sufficient profits that will meet the expectation of required returns. In our example, the required returns were 11%. When we tested the projected cash flows at 11%, we found that the cash flows, the net present value was above 0. This means that we can now say that the decision criteria for net present value is that if the project's net present value is greater than 0, then the new investment becomes financially feasible. Thank you.